Hello, friends. Comes February 1, and all eyes are on the FM to unravel the most awaited event of the year, Budget 2022. Every person, whether businesses or people in common, expects the government to wave a magic wand and leave more cash for him to spend. The government, on the other hand, would be hands tight due to the various monetary packages already announced during the year to combat the pandemic, and hence it would have limited headroom to announce any mega packages through this budget. Having said that, the tax collections, both direct and indirect taxes, have been buoyant till now, and so have been the M&A market. And these reflect sign of business revival and confidence. Hence, our expectations from this budget should not be any mega packages, but just those select enablers in the policy framework that allow this momentum to continue towards a sustainable growth. My first expectation in this direction is a facilitating tax and regulatory framework for outbound mergers and direct overseas listing. An outbound merger means merging an Indian company into a foreign company. And while the regulatory framework for outbound mergers already exists, having a specific neutralizing provisions in tax law is the need of the hour. Likewise, government had announced to also allow direct overseas listing of Indian companies. This was way back in April 2020 while introducing the Atmanirbhar package. However, these regulations are yet to see the light of the day. Both of these tools are crucial for the Indian businesses, especially for the growth-oriented startups, to pursue their foreign markets ambitions better. Whether it is a transaction with Special Purpose Acquisition Corporation, what we globally refer to as SPEC, or a foreign strategic buyer, or a private equity. The next in line is the startup sector, which has showcased phenomenal growth, especially in past 12 months. We all know that startup encourages entrepreneurship and creates jobs. Having said that, it also needs consistent monetary support in the formative years. Hence, it's very essential that the supportive tax framework that leaves more resources in their hands continue few more years. And keeping this in perspective, the sunset clauses of tax holiday provisions under Section 80 IAC and long-term capital gains exemption under Section 54 GB should be extended from 31st March 22 to at least 31st March 25. Secondly, to enable startups raise funds from risk-oriented domestic investors, introducing a concessional long-term capital gains tax regime of say 10% on startup-related shares and securities would be a valuable booster. The third ask is the removal of tax impediments for distressed asset transactions covered under IBC. So exemption from MAT on haircut adjustments received by a distressed company or exclusion of NCLT approved buyouts under IBC from the realms of gifting provisions under Section 56 has been the need of the hour since the inception. Another thing I can talk about is in June 2021, SEBI replaced the old delisting regulations of 2009 with new regulations. Now, Regulation 37 of the latest regulations now allow delisting of listed subsidiaries held by listed holding companies through a NCLT process. Now, broadly, this process entails a share swap arrangement between the listed parent company and the public shareholders of the subsidiary, and this is done through a NCLT scheme under Section 230-232 of the Companies Act. If properly implemented, the subsidiary gets delisted and becomes 100% owned by the parent, and the public shareholders of the subsidiary, on the other hand, becomes the shareholders of the listed parent. A very welcome change that allows delisting in an economical manner, unlike the traditional and expensive delisting through the reverse book building process. Having said that, there are few tax lacunas that needs addressal. The first being the specific tax exemption under Section 47 for the share swap transaction in the hands of public shareholders. The public shareholders, if they are required to cough out taxes, they may not support such a transaction to avoid the adverse tax impact. The other one is a rollover of shareholders' tax basis and holding period of subsidiary shares to the new parent shares issued under the transaction. And this will facilitate keeping tax neutrality for the transaction. So both of these areas need to be addressed for this regulatory amendment to succeed. The list can keep getting longer. For example, take the case of Section 79, where an exception can be made for genuine mergers, or take a case of Section 72A, where benefits of past unabsorbed losses rollover can be extended also to mergers in the service sector. I would just hope and pray that our honorable finance minister is listening. Thank you.